Hello everyone and welcome to another Elliott Wave forecast intraday video day. My name is Eric. Today is the 12th of January around 4:47 p.m. Eastern Times, and as we always do, here we go with a video in which we're gonna take a look to something interesting that is being either talked around the market or it is happening in the market. In today's video, we're gonna take a look at the relationship between oil, which is the line in blue, and the S&P, which is the line in black. These two, contrarians to, I'm not a big fundamental person, but I tend to believe that the fundamental traders believe that lower oil mean higher indices. And when I look at the charts, it looks to me that is otherwise. It tends to look to me that the oil correlation with the S&P is huge, and that wherever it goes the S&P, it goes oil, and wherever it goes oil, goes the S&P. Contrarians to what the logic say that the lower the oil trade or the oil price, the better for the company. The charts tends to look otherwise. I wanna say before I enter into the analysis that in Elliott Wave forecast we look at the market in some different ways. In the way that for us there is a direct and an indirect correlation, but also there is another type of correlation in which the market trade the same side even though not the same direction. Not many traders use that, but I just want to be clear here. We have a name for that, in which during the video you guys gonna see what we meant with this. Okay, so looking at the chart right here, I want to tell you guys all to understand how the trade works. It's very simple. The blue line, which is oil, this is a chart of oil since the 1993 levels, and this is the zero line, meaning that I guess that nobody expect oil to trade below zero, in my humble opinion. So with that being said, the periods that are highlighted in blue means that oil and the S&P in black, they trade the same side. Now over here the oil trade lower, and the one in orange is when oil trade lower and S&P trade higher. So if we get a data that it comes from 1986, this suggests that out of almost 30 years in data only for 1994 and 1990 to 1994, and from 1996 to 98, 6 years, oil and S&P trade in what it looks to be an inverse correlation. Also needs to be pointed out right here that over the last, since the middle of 2014, oil is being trading in what it looks to be inverse to the S&P, but it is no inverse. It is in what we call the other dimension of the market. So I feel very comfortable looking at this almost 30-year data that I'm seeing that the indices over here, that the oil trade over here, it has a zero line or a floor over here. I feel very comfortable in downgrading the chart right here to a little more to the daily chart. I can see how from the 2011 chart I mean, this chart is the last part over here from 2011. All right. Oil looks to be sideways to higher before the drop. And if we look at it here, every rally in cycles is positive correlated. Right here, for a period of about, I would say, a month, they trade inverse. Over here, the same, they trade inverse. Over here, they trade inverse. And I want you guys to understand now from the decline in oil, the one that started around July, how they went together, a little inverse, together, a little inverse, and how over here they are together, even though oil is dropping, but S&P is sideways. If you subdivide every swing within the sideways in the S&P at the top, correlate, guys, perfectly with every drop and correction into the oil trade. So with that being said, don't be fooled thinking that lowest prices in oil represent higher indices, because technically, knowing that oil is at the lows or closing to the floor of zero, it makes me to believe that the indices are consolidating at this stage, waiting for oil to reach a low, and then the indices can start entering the wave fight that we are expecting in some of them. As you see, guys, the market is not always make sense within the fundamental trade, because I do understand that the logic would say that lower prices in oil means cheaper. The companies, they should take profit out of that. But the charts are saying otherwise. So we are technical traders. We don't believe in the fundamental stuff the way that some believe. And for us, this is very simple. This is a blue correlation, in which, most of the times they correlate within the blue box, and most of the times the trade means that lower that the S&P and the oil, they trade the same side of the market. So look where oil is, look where the natural floor of oil is, which is zero over here, and do your own conclusions after seeing this video. For more, guys, this type of videos and this type of analysis, I challenge you guys, join Elliott Wave Forecast. It's a free trial for it's a $9.99 per 14 days of trial. It's 41 instruments updated. 4 times a day. The basic plan is 26, the extra 41s, 3 live sessions, technical videos, a lot of stuff, and a lot of deep analysis of the market like this one, that sometimes there is nothing more logic that is going against the logic. All right? So keep that in mind, and I hope you guys like the video. Thank you, guys.